Right now, this week, the market is revealing what stocks will be AI winners and losers over the next year. And I'm going to show you precisely why and show you my two favorite winners. I'm Matt Weinschenk here at Stansberry Research, and I've been doing this for nearly 2 decades. So stick with me for a few minutes, and I'll tell you the most important information you need to know, and I'll tell you my 2 favorite mega cap tech stocks to play the AI boom. So in AI stocks, we've gotten powerful information in recent weeks, and it's the kind of information that you can put to work in your portfolio. I don't have to tell you that everything AI has soared this year alongside gold and commodities, power generation plays, and more. But the AI boom has led to inevitable predictions of an AI bubble. That sort of talk has spread from financial circles to the general media and likely to the conversations you have in your daily life. So everyday publications like the New York Times, Reuters, the Associated Press, they don't typically make stock predictions, but they've all declared that the prices of AI investments have gotten out of hand. But the mainstream media is missing what the word bubble really means. A bubble is an investment frenzy that leads to a misallocation of capital. Big words, but it's a very important concept. There are hundreds of billions being poured into AI, and some of it is going to go into AI losers. It's going to go to bad ideas, and those investments are going to go up in smoke. That's what happens during bubbles. Someone has to fund the losers so that we can create the winners. But you don't want to be the one to fund the losers. You want to own the Amazon.com, not the Pets.com. And that's what we're going to figure out today. Now, speaking of AI, Stansberry Research is working at the cutting edge of AI to help viewers like you. The world is changing, the way to invest is changing, and there's a full-scale financial reset happening. If you want to know how to use AI in your own investing, go to stansberryaisystem.com or scan this QR code right now if you want to be one of the AI winners. Now, as far as stocks go, with the earnings and announcements the last couple weeks, we've learned a lot about the AI winners and losers. For now, the truth about AI is this: it's more about spending than it is about profits. That's why earnings from Meta Platforms, Alphabet, and others were so closely watched. Everyone wants to know if they will keep spending billions on AI infrastructure. After all, that is the fuel for the bubble. And the answer so far is still a resounding yes. If you total up the capital expenditures from the hyperscalers, they're now spending $330 billion per year, and that's going to go up. All the big names announce plans for more spending. So for investors, this is important. These companies make up a huge part of the market. If you've got an S&P 500 index fund in your portfolio, you've already got nearly 30% of your capital in these stocks. All this spending is fundamentally changing the financial power of these mega cap companies. And to understand why, you have to look at the difference between earnings and cash flow. So on an earnings statement, a data center doesn't cost you that much. If it's going to last 10 years, you book an earnings hit this year of 1/10 of the cost. Now, on the cash flow statement, you pay for the entire data center today. So one argument for why these mega cap tech stocks can continue to rise is that they're so profitable. Yes, they're huge, and they produce huge earnings to justify those valuations. So on a price to earnings basis, Meta trades for 22 times, Alphabet and Microsoft are more like 30. That's expensive, but it's not insane. However, the cash flow tells a different story. Even with their historically huge profits, you can't spend hundreds of billions of dollars without it costing real money. And the cash flows are no longer following net income. These tech companies have gone from capital-light cash printers to looking more like an industrial firm. And that brings me to the division we saw over the past couple of weeks that's pointing us to the winners and losers. So let's start here. Meta announced spending of $72 billion to round out 2025, and that 2026 would be notably larger. The market hated it. Shares dropped more than 15%. But the opposite happened to Alphabet. The parent company Google announced spending of more than $90 billion for 2025. That's up from previous projections, and they plan a significant increase in 2026. But their shares have spiked upwards. So you got a winner and you got a loser. What's the difference? Well, I want you to look at 2 specific things. Number one, while Alphabet is spending on AI, it's also earning from AI. Cloud revenue grew 34% to $15 billion for the last quarter. And that growth is driven by companies using Google Cloud to host their AI apps. Now, that also applies to something like Amazon earnings. Their cloud division grew 20% last year. That's the fastest pace since 2022. And shares surged. And that's after they've lagged the rest of the Magnificent Seven for much of the year. Meta, on the other hand, doesn't earn any revenue from compute like Alphabet and Microsoft do. Meta only spends. So the lesson here is that it's still better to be a recipient of AI spending than the AI spender. Now, down the line, the promise of AI is that someday this equation will flip. Someday the AI firms like OpenAI will eventually see a return on all this spending and become profitable themselves. That's the thinking. But for now, for this month, the market's not rewarding that. And here's number two, another feature separating winners from losers. Meta is spending on a big future for AI. Alphabet is using AI today. So yes, AI may help Meta's social networks and advertising business, but Meta is not in the AI race to make incrementally useful AI models. Zuckerberg's plan is to pursue AI superintelligence. This is a big bet on a big future. Meanwhile, Alphabet is providing AI to millions of users right now. Its flagship Gemini app has 650 million monthly active users, query numbers have tripled, and AI is driving search volumes higher, according to company management. So what the market's telling us is that real AI today is more valuable than promises of a far-off techno future. A lot of investors remember Mark Zuckerberg's wasteful foray into the metaverse, and his superintelligence obsession sounds just a little too familiar. So when you put these things together, you can sense what the market is doing. It's acting a bit more rational, and it's rewarding firms with more concrete results. Now, you also see that the most levered AI plays have cooled a bit. That's where the warning comes in. So these are the stocks you need to watch to understand what the market thinks of AI. So first up is neo-cloud plays like CoreWeave. These firms operate data centers specifically designed to take on marginal AI computing demand. They are the most levered to AI's upside, and they will be the first to suffer the downside. CoreWeave has cooled 15% since last week. And Palantir is the pure play AI company. It's deploying machine learning tools inside business and inside government. But the issue is that Palantir shares have run up to such a lofty valuation at 460 times earnings that it will be the first struck by a decline in AI sentiment. It's down about 7% after its earnings, but to be fair, that's just a blip on a long bull run. So CoreWeave and Palantir, those are the two stocks you want to watch for a warning. They will be your canary in the coal mine, so to speak. But overall, the takeaway from recent AI news is clear. Spending continues with no signs of slowing yet, but it is better to receive AI money than send it out the door. And if you are spending, you need to create real AI products for consumers. This will make winners out of several mega cap tech stocks, and here are my two favorites. I've long pointed to Alphabet as an AI beneficiary when others called it a victim. At the release of ChatGPT, many considered it a search killer, and Google shares plunged, but that was short-sighted. Alphabet invented the transformer models that underpin LLMs. Its AI tools like Gemini and Notebook LM often top the AI model leaderboards, and it's already got billions of users that it can put its AI tools in front of. I've called Alphabet the hidden leader in AI as early as February this year, and it's been a rocket of a stock. Alphabet benefits both from AI spend through its cloud division and from its real-world applications, so it's still my favorite of the Magnificent Seven. And speaking of AI spend, Nvidia is still the most direct beneficiary. However, as early as July of 2024, at Stansberry Research, we proposed that Cisco, with the ticker CSCO, made a better play for investors. Its networking equipment is vital in the data center build-out, and its product is winning market share from Nvidia's networking products. Over that time, Cisco's provided about the same return as Nvidia, outperforming it for much of the year, and it's dramatically less risky to own Cisco at 18 times earnings than Nvidia at 45. So the playbook going forward is clear. Monitor AI spend, focus on these winners, watch CoreWeave and Palantir as your bellwethers for AI sentiment, and they'll give you the warning you need when things turn around. Now, before I go, I need to point out that Stansberry Research is working at the cutting edge of using AI to help investors like you. We just launched a fully quantitative system to select the best businesses in the market and combine them into an AI-driven portfolio that any investor can follow. It's built on the proven fundamentals of finance paired with AI. The back-tested results are incredible, beating the S&P 500 Gold, a 60-40 portfolio, even Warren Buffett's Berkshire Hathaway. And you can learn all about it at StansberryAIsystem.com. Right now, there's a link in the description. And as always, like and subscribe here on YouTube. That is all for now. I will be back next week.